Hey everyone, me Kevin here. Yesterday we talked about how housing market inventory was starting to inflect up and that we've got a substantial move up in the amount of homes on the market with price drops. We went into detail in that video yesterday, in that video called The Housing Market Crash Has Started. But today, we have even more information, even more detail that's going to provide color to us in terms of how high do we actually think interest rates are going to go, how high do consumers think interest rates are going to go, and how much of an impact is the Federal Reserve's quantitative tightening going to have on interest rates? We've got answers to all of this, along with some more data points that we got to talk about. Let's start with some of these data points and then get into some of the answers. So first, we know that the founder of the Real Estate Case-Shiller Index suggests that memories of a housing market bubble may be coming back soon. Then, we see demand destruction in lumber, which is heavily driven by the housing market and how much people are actually building new homes, specifically home builders. But it's no surprise that when home builder sentiment falls 17%, that we also see demand destruction in lumber, and lumber now hitting a 9-month low, dropping 4% today and essentially plummeting back to earth. Now, lumber prices had skyrocketed during the pandemic and in 2021 as home building went crazy. But some say that lumber prices falling could be a leading indicator that, yep, real estate markets are definitely slowing down. What else do we have? We have comments everywhere, whether it's on the Bloomberg terminal, in the comment section down below on YouTube, or in real estate news websites like Inman News, whatever. Everyone in the industry, inside the industry, seems to be talking about the clear as day slowdown that's happening, whether it's in lending, in building, in sales, you name it. Then we've got mortgage volume down 31% year over year, 18% quarter to quarter, that is Q4 to Q1. And you might be thinking, well, I mean, that's going to include a decline in refinances, and you're right about that. Purchase volume, though, down 12% year over year, but also purchase volume for loans down 18% in the first quarter compared to the fourth quarter. This is the fastest decline that we've had in 8 years. However, home equity line of credit loans going up. This is a good thing. Nice thing about home equity lines of credit is during high interest rate environments and you wanting to take money out of a property, you can take money out of a property with a home equity line of credit, but not use it until you need it, which means you're not actually paying those higher interest rates until you need the money. So I'm a big fan of HELOCs. Used to be a big fan of RELOCs, rental property lines of credit, but those are almost impossible to get right now. So these are some updates on what's going on here, but the big thing that I want to talk about now is what we actually expect during a tightening cycle from the Federal Reserve. Where do we think mortgage rates are going to go from here? I do want to quickly mention, though, that you can get $200 totally for free with Tasty Trades. It is the same company as Tasty Works, the t-shirt I'm wearing here. All you have to do is go to metkevin.com/tasty, deposit $2,000 with their brokerage platform. They will give you $200. No questions asked. $200, you leave your money in there for 2 months, you'll get $200. It's not up to $200. It's literally, here's a free 10% on your money, and it's a special offer that they've got going on. So check it out by going to metkevin.com/tasty. All right, so what do we got here? We got peak 10-year treasuries. When are we going to hit a peak with the 10-year treasuries, and why do we care about the 10-year treasury? 10-year treasury sitting right now at about 3.04%. When we were last at this level in 2018, in about May of 2018, what happened? Mortgage rates capped out at about 5.5%. This is roughly where we sit right now. Mortgage rates at 5.5%, 10-year treasuries just above 3%. We expect this to stay connected. That is, if we see the 10-year treasury yield go to, say, 3.25 or 3.5%, we'll probably start hitting the range of 6 to 6.25% in mortgage rates. And remember, every percent that mortgage rates go up, real estate purchasing power goes down by 10%. So a substantial move, especially since rates have already gone from about 2.5 to 5.5. That's already a 30% decline in purchasing power. We go to 6.5, that'd be another 10% decline in purchasing power. But anyway, so we track this 10-year treasury. And so what we want to know is how much higher do we think the 10-year treasury is going to go in a Fed quantitative tightening cycle? And to get an answer on this is very, very difficult, but we have an estimate, and it comes from the Atlanta Fed. Take a look at this document right here. This is a printout from the Atlanta Fed, and we get sort of, I'm just going to give you the bottom lines here because this is a pretty difficult read, but anyway, we get some bottom lines that if we get secular stagnation, that is, we see a stagnating economy while at the same time we have high inflation, the Fed's going to find it very difficult to figure out exactly where to keep rates. And in the short term, we could see rates in the 10-year move higher. But in the long term, we think that Federal Reserve rates could once again go back to zero. That long term, in my opinion, probably going to be somewhere around 2024, 2025, where we see the Fed go back to a 0% lower bound on the Fed funds rate. That'll bring this 10-year Treasury back down, right? So that's nice. That's good hopium for the long term, 2024, 2025. But what is the tightening cycle now going to do? Well, we hop on over here, and the expectation, at least from the Federal Reserve panelists, is that quantitative tightening, right here in pink, will likely have a moderate effect on market rates, perhaps raising the 10-year Treasury yield by somewhere between 25 to 30 basis points. So going back to here, that means the quantitative tightening cycle alone, which is just beginning, just started June 1, is pretty much guaranteed to give us 3.25 10-year Treasury yields. But if we get a miss on this, and this panelist is wrong, and the tightening cycle actually has a larger impact, it wouldn't be shocking to see a 3.5 to 3.75. So we're definitely going to get some more headwinds here in the 10-year Treasuries, which once again translates to mortgages, which once again translates to purchase demand, mortgage volume for refinancing, less money flowing into the economy for stocks and purchasing, more deflationary pressures, less demand for lumber, and that potential slowdown in real estate prices. Now, what are consumer expectations as in terms of where do consumers think mortgage rates are going to go? And when do we think that we're going to have a potential bottom of the market and then the recovery, right? So let's talk about that. But what I would want to do is mention that if we end up getting any kind of reduction in prices in real estate, or real estate prices end up softening, we go flat for, let's say, 6 months to a year, and then we kind of start U-turning back up. Either way, in my opinion, because real estate is certainly one way that most people end up 10xing their net worth, you might want to check out the programs on real estate that I have. There's a link down below for a coupon 50% off. We've got a program on real estate agents and sales, do-it-yourself property management and rental renovations. You don't have to hire a property manager if you don't want to. Zero to millionaire real estate investing to help you identify those deals, whether it's multifamily, single family, you name it. It could be commercial real estate, anything. These principles are designed to save you money, especially with our partnership with Lowe's that gets you special discounts at Lowe's. But also, if you end up wanting to buy these programs and you get the Zero to Millionaire Property Management course, you can use Bundle 3 and get 50% off on Bundle 3. That gives you some additional special pricing here. But if you also get the sales course and you watch this video, send me an email at kevin@meetkevin.com and we'll get you a $150 bonus after you check out. So if you buy Bundle 3 and you get the agent course, send us an email afterwards and we'll shoot you an extra $150 back. Okay, so what do we got to talk about here? Consumer expectations for inflation. So this is a little scary because this doesn't really align with my thesis that we could end up having some kind of Federal Reserve U-turn by 2024, which would generally align with the idea that, hey, if the Fed drops rates again, we get the 10-year Treasury to come back down, and then maybe we see the housing market kind of continue on its way of what we've seen, which is nice home price appreciation, right? Well, the problem here is that consumers are expecting that by 2025, we're actually going to have mortgage rates of 8.2%. Fact check that. Google it, okay? Consumer expectation mortgage rates by 2025. Type that into Google. Type in 8.2%. You'll get endless articles on this. And it's quite remarkable that the course that we have here for the 10-year Treasury would really only be consistent with about 6 to 6.25% mortgage rates. But there's so much fear in the market that mortgage expectations are that we could see rates as high as 8.2%. Now, ironically, and this echoes what Mr. Schiller said yesterday, ironically, that could actually lead to some temporary buying of individuals wanting to get into homes and rush into homes around this 5.5% mortgage rate, where people are paying about half of a point right now to get this kind of mortgage rate, which is pretty expensive already. And if people are buying now, we could see a temporary kind of buying at peak. And if these folks lose their jobs, we could end up having problems, especially if prices do end up falling, or we even trend to the 6s or even 7% mortgage rates. That'd be incredible. 8.2 by 2025. This implies that we could end up, because real estate lags, right? We get 8.2% mortgage rates in 2025. This implies that we could be in for 4 to 5 years of pain or flatness, mixed in there, for real estate. That's pretty substantial. Though, if that is true, which I really think we're probably only going to be in for about maybe 2 years of pain, right? So this is the Kevin estimate, and this is sort of the consumer sentiment estimate based on mortgage expectations here. Either way, if we have this kind of pain in the real estate market, either way, there'll be some big buying opportunities that we want to take advantage of. And that's why you want to check out those programs on Building Your Wealth link down below. Make sure to get 50% off while you check out as well. But another thing that I want to show, which I think it will be very interesting, is we've got this forecast here from the Financial Times on screen now. And this is the Financial Times present forecast on home price growth. And if you look at the bottom right, you can see that for the Eurozone and the United States, they're not actually forecasting a decline in prices. So even though we have all of this data right here that's pointing to a definite slowdown in real estate, and my expectations that we're going to see some form of a decline in prices, my base case scenario is 10 to 15% of declines in home prices off of peak, and potentially worst case, we could go to 20 to 30% declines. But if we go back to this chart here, we can see that the Financial Times isn't actually expecting any kind of home price negativity yet. Now, I actually think this could be dangerous, because if I go to the next slide that I have here, we already see, and we talked about this yesterday as well, we see inventory levels shifting in just the last 6 weeks, with any area in blue seeing in light blue somewhere between 0 and 20% inventory increases. Well, over 0%, obviously, to have any color to it. Otherwise, it'd be gray. And then in the darkest blue sections, we get anywhere between a 20 to 50% increase in inventory levels. And some of these red areas here are actually still seeing decreases in inventory. But you can see you've got parts of Florida over here. You've got parts of the Rocky Mountain area here. We've got California. And so what's fascinating to me is that you could have economists suggesting, oh, don't worry, everything's fine. There's no housing bubble. Yet data's pointing to the potential for declines. So this is another concern that I have, is what happens when we actually start getting this? When we actually start getting home price declines? What happens in that case? Is there a potential for individuals to panic? Especially as mainstream media starts going, hey, look what happened, everybody. Look what's going on. And so this is why I think we want to be as prepared as possible. And that's why I keep saying now is the best time to start learning. Remember, 0 to Millionaire for identifying deals and understanding real estate, getting started. Once you're in, do-it-yourself property management, rental renovations, guides on spend money on this, not that, save thousands to tens of thousands of dollars. This is an investment into yourself here. And then, of course, if you're a real estate agent, learn all of the tactics that I've used to sell real estate better. Thanks so much for watching, and we'll see you in the next one. And good luck.